All right, seeing visuals good, everything's good. All right, cool. So, access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed to track and monitor virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, or any of their respective offices, personnel, agents, or independent contractors are in such capacity licensed financial advisors, registered investment advisors, registered broker dealers. Nothing in any webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides education and training services meant to teach the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money in the account or force lose. Past performance does not equal future results, and results discussed in this webinar are not typical and only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold you above harms for any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and will not distribute or sell your information to anyone. Fantastic. We are ready to go. All right, guys, so what's going on today? We have Powell speaking. He's still speaking. And not saying anything is worrying anybody, apparently, because the indexes are still pretty much up. We had a huge spike in the morning, then it calmed down. Now we're coming back and we're clawing our way back to the highs. So that's a positive, I suppose, if you're into the bullish stuff. Gasoline plowing up to $2. Oil hitting 60. Oh, look at that, 666. My little one goes 666. So Brent is 666. And now notice, remember there was like a $10 spread between Brent and U.S. crude. Now it's only 666, so it's or 66. Wait, six. Yeah, that's only 660. And we will see how far it can go. But I think this should probably be it. In fact, gasoline is probably a pretty good short here off the below the $2 mark. It's going to be kind of hard to cross, and you can see that you got your resistance here at 60 on crude too. Also a good shorting line if you want to use that. So this is where you would expect to see some kind of rejection. So, there's no particular, now where's the dollar? That's the question. The dollar is at the moment coming off of this line down here. Oh, also hit 66, 96.66. So somebody's messing around. And by the way, that is something manipulators do. They do these little like fun signals they like to put into the market. So when you see that kind of stuff, or you see the high at 66.66, you know somebody just like, that's something someone does to show like their friends how they can totally control the market. It's lots of fun. If you're a Wall Street guy, that's what you do for fun. You like manipulate the market and send signals to your friends. And that way you can be cryptic about it later and say, see what I did, see what I did. Anywho, so everything's pumped up to most of the extent the dollar, which is down 0.4% for the day, and the index is up 0.4% for the day, except for the NASDAQ is up 1%. How's Apple doing? Let's see, we'll replace copper here. Yeah, so Apple's back up after that little scare they had last week, all the way down to 197. Ooh, what a sale! And if you don't have them now, it's kind of a good time to look at your hedges and see if you feel hedged enough. And let's take a look at where we are. And we just went over the short-term portfolio the other day, but let's take another look because it's very important. So, you know, this is where we think the market is very, very toppy at 3,000 on the S&P, and we're looking for some kind of pullback. And the short-term portfolio is where we have the main hedges for the long-term portfolio. Not too much damage. I mean, we were at about 666 too. We were about 760 something thousand, and now we're at 735. So we lost about 30,000 bucks on our hedges. But that's okay, and this doesn't count. We added some short puts yesterday to make up for some of these losses. But you know, this is the insurance. We pay this money to protect the very large gains in the long-term portfolio. You know, which is making just unrealistic amounts of money, and you want to just sort of try to protect it and lock it in. So we'll see what happens. Here's our gasoline spread, though. That's going to come to a halt. Is it next week, I guess? Next Friday, this gasoline spread finishes off, and our target was 32. So, you know, we have the 29.32 spread, and we sold the 32 puts. We are very close, and the potential for the spread is 20 times 3, so $6,000, and currently it's 60. $56, $46, $40. I don't see any real reason though why gasoline. We have that refinery fire that took out some of the production in the U.S. and you still have the OPEC stuff that's flowing through. So I don't think there's really a reason we should like not wait and take the extra $1,800 as it's coming to us. But we are right at 32. We're at 32.50. So I also, on the other hand, would hate to see it slip away. Soybeans are doing very well, but I guess, yeah, well, you know, look, we're very happy with this gain. That's like, you know, keep in mind the short-term portfolio. We're just doing this to make a little bit of extra money on the side. You know, while, you know, against what we expect to be losing money on these insurance plays. You know, because mostly like we expect to lose on SDS, we expect to lose on DST, we expect to lose on SQQ, we expect to lose on TNA. If the market's going up, we're going to lose money. Look at this, we lost $40,000 on this one. That's our big loser, really, of the group. But this is a massive hedge. And this hedge is all the way till 2021, so it's okay. It doesn't matter if we lost it. This is insurance that's going to last us for 18 months. But at the moment, it's down $50,000. It's still $200,000 or $180,000 worth of insurance that could easily triple if the S&P has a really bad run. You know, these are the $30 calls. The $30 calls are currently $9, and if the S&P drops 20%, then these will go up 30%. So they'll be like $42, let's say, roughly. And at $42, these things go to 12 or 30, you know, plus 12. So maybe double, not triple. So those can maybe double on us if the S&P, if the NASDAQ has a big slip. It probably won't. We're not going to shoot through the whole 180 though. We're going to at some point sell calls, but we do expect a pullback sometime so we can sell the calls for a bit more money than they are now. But anyway, the point being that these long-term plays, these long plays that we have, and MJ, by the way, is losing money, so it's not working as a long play. The long plays we just put in to offset these losses. You know, we just look for quick ways to make money. So we have Caterpillar here is making $4,000. This one's making $5,000. This one's making $4,000. So you know, we have like 30,000 in gains to offset some of these losses, these 40,000 in losses. That's pretty good then. That means all that insurance on SQQ against the offsetted the positives that we have in the portfolio, it's only down about $10,000, but we have hundreds of thousands of dollars worth of protection here. And that's how we keep it under control. When you know that a sell-off is going to cause you to gain $180,000, you can be aggressive with a few things that will make money when you're not going to have a sell-off. That's all about balancing your portfolio. And you constantly want to balance. You say, I have too much of this, so I should buy some of that. I have too little of this, I should buy some of that. You always want to be balancing everything out and trying to keep an even keel so you can ride through the markets on conditions. And especially in a hedged portfolio, because these are the hedges. You know, we would like to have something that makes money when our hedges are losing money. And obviously, yeah, you know, in the long-term portfolio, we make plenty of money. But you know, I'm talking about even within the short-term portfolio, within the hedges. And if you have a condensed portfolio, which is, you know, the hedges are in the portfolio, like the options opportunity portfolio, then it's just a question of saying, okay, well, I just added this SQQ play, which is down $11,000 in this case. Now notice, because we weren't as aggressive in the OOP as we were in the short-term portfolio. What else do we have for a hedge? We have the DXD. See, the DXDs are down 12 plus 5 is 7,000. There's 7,000 down there. Do we have TZAs still, or we gave those up? No, we gave up the TZAs. So we really just have the DXDs and the SQQs. And so the DXDs are costing us, what did I say, 7,000 bucks? Yeah, so $7,000 down on these, and the SQQs are, oh, we have the TLTs too. No, it doesn't. That's not the same thing though. And we have 11,000 there. So we have an $18,000 loss on our hedges, but we have some ridiculous gains on our longs. Oh, here's the TZAs. This is just the remainder of that spread, though. We cashed out the rest of the spread and did very well. These are just the loose short calls. I'm sorry, the loose long calls that are effectively dead at the moment. Well, they're not really that. Oh, no. I'm sorry. They're not that dead. They're split. So we actually are doing better than it looks, because this was from the pre-split, and TZA is not that level anymore. And those never got adjusted. They should have been. Let's see. TZA is now 45 bucks. I forgot what the split was on TZA, but whatever it was, I guess it's 1 to 5. So that means these TZAs are really 20 of the new 5 times 8 is 40. So they're 20 of the $40 calls of 2020. So they're not worthless. The 2020 $40 calls are, oh, they're 8 bucks. So actually, yeah. So those are worth substantially more than nothing. So we don't have that big of a loss there. It's just not reflected on the sheet. So really, it's only like a $10,000 loss. But anyway, the point is, I mean, obviously the longs are doing very well, and it's a matter of just the hedges are doing their, well, they're doing their job. I mean, you know, the hedges are doing their job. You're losing money. Okay, the only reason we make a lot of money on the short-term portfolio is timing, because when we see these dips in the market, like, oh, conveniently, there's SQQQ. So, you know, we've had these hedges the whole time, and what happens is when it goes against us, we buy more. When it flies up, we sell. When it goes against us, we buy more. When it flies up, we sell. When it goes against us, we buy more and more and more until we have a huge amount of hedges like we do right now. And then when it flies up, we sell. You know, we don't just sit on the hedges the whole time. When the market bottoms out, when the market turns down and looks like to us that that's now oversold, we will cash in our hedges and take a risk. And if you hedge properly, you can afford to take the risk, because the cash that you put on the side from cashing in your hedges should be enough to buffer a little bit more of a downturn. So then your cash becomes your hedge. But then if you cross a certain line, you have to very strictly say, okay, if we go below that line, I'm going to reinitiate the hedges. But what we're hopefully going to get here is a nice little W kind of pattern. So we go down and up and down and up. Now, of course, that's going to be disastrous for the market, but it'll be fun for us. So if we look at SPX, I mean, we will make an incredible amount of money if we have a big downturn at this point. So the same thing, you know, we have this up, we have this huge downturn, but look, it's at the 200-day moving average. So we took the money, then it goes back up. So in other words, it comes down here and our hedges go up. This is the actual S&P. So our hedges max out and we say, wow, that's about as much money as we thought we'd make. It went all the way down to the 200-day moving average. So we cash out our hedges. Then it goes back up. Now, when it's down here and we don't have any hedges, we don't need hedges anymore. So when it went up on this leg, we didn't have any hedges. We started buying more hedges here. Then it goes back down here, back below the 200-day moving average. We say, whoa, let's cash it out again. Now, if it had started making a new leg down below 2,500, we would have bought more hedges. It's not complicated, but it didn't. So we said and we came back up. And I'm not sure what happened here. I remember that clearly. But then here, clearly, though, we had, you know, we were hedging. At this point, we started hedging a lot. I think in 2,900, we started hedging. Then we caught this incredible move down, which made us a fortune. And in fact, that's where most of our gains came on the short-term portfolio. And again, though, when this crash ended, when we hit 2,500, this crash ended, we had no hedges anymore. And we rode this out with our cash and said, well, you know, we can deal with this. We were mostly into buying. Back in December, we were buying like crazy. In fact, it was December 26th that we called the bottom. So it's basically down around here, which is where we made a bottom call. And that was perfect. So we cashed in all of our hedges. I remember that, it was December 26th. So it was right after Christmas. And we cashed in our hedges. I guess that must have been the Monday after Christmas or something. I don't remember exactly. I don't know why it was the 26th that we made that decision. Oh, I see. Yeah, it was the first day back. So we had, you know, it was Christmas Eve, Christmas Day, and then the 26th was the day we came back from Christmas. And I decided that this was going to be the time to flip. So we wrote out Christmas. We decided that we were going to take a chance in the new year that we'd bounce. And fortunately, we did, because we had a huge bounce, ran up, and we started reinitiating our hedges around, you know, up around here somewhere. We did a little cash out recently, and now we're back, and so now we're maxing out our hedges again. But it's the same thing we always do. You know, it's not. It seems, I don't know. It always seems at the time when you're in it that you guys are, you know, it happens a lot because people say, oh wow, you know, we got a lot of hedges, we're being very aggressive, but it's only the same pattern we always follow. You know, when the market gets to a top of the range, we will put a lot of hedges on, and then when it comes back down in the range, we will be very happy to take it off. Now, down in the range now is a lot different than down in the range here, because down in the range here was 25.50. Now down in the range is 27.50. So the range has moved up 10%. You know, when it hits the 200-day moving average, we're probably going to lighten up on our hedges. If it goes down to the next level, though, we're going to be prepared to add other hedges. But again, like I said before, the SQQs are going to make a W pattern. Well, that's the opposite pattern the S&P is going to make. It's making an M pattern. And the question on this M pattern is, will this be the bottom of the M, or will this be the bottom of the M? Will it come all the way back down to here? And we won't know that until we're back down here and we see if that line holds. You know, but what are the circumstances? Well, you have most likely it'll be something like a breakdown in the China trade talks, which the chatter I hear is not that good of the trade deal that we're working on. We'll have to see how it resolves itself, but that's the most likely thing to screw us up. And then, of course, you've got the bad Brexit stuff. So we have the bad Brexit possibility, the China issue, the fact that the factories' outputs is slowing down all over the world, that there seems to be a global recession happening that we're completely ignoring. And let's see that, China and Brexit. And of course, a bad Brexit can throw Europe into crisis, and then the whole thing collapses also. So there's three major things that could collapse us now. Oh, also, you know, still the Trump administration could end up we could end up with, you know, a big impeachment thing and all sorts of stuff. And, you know, that's still very much a possibility, because if anybody actually reads the Mueller report and looks at what's being said and what Congress is talking about, it's not good. You know, Trump is not even close to exonerating. That's another thing that can throw the country and the economy into turmoil. Oh, Theresa May is talking now. In fact, what is she saying? Oh, she's talking about an ambassador. He resigned. That guy, he got into a fight with Trump and he resigned. All right. Anyway, so we'll see what happens. But bottom line is, S&P 3000 is a bridge too far. And it's very likely that we are going to pull back from this point and rethink the line. And if you notice, though, 72, right? Then we're up about 60 from there, and now we're up about another 60 from there. And 60, by the way, is 2% of 3,000. So we're moving in these 2% increments higher and higher and making new highs. But each time, though, we have a pretty good pullback before we get back to the next level. So it'll be a strong indicator that we could actually break over 3,000. If we come back down here and hold it, that's actually kind of bullish. You know, to test the 200-day moving average. I mean, the thing is, nobody these days has any patience for it. You know, they freak out if we have a 10% pullback, but that's a good, healthy pullback. If we pull back here, consolidate on the 200, and then move back up, that's a good breakout. And, you know, in a long-term chart, these little things are nothing. And that's the other thing. I always like to look at the long-term charts for perspective, because where to go? Futures. That's it. There we go. So we look at the S&P on a monthly basis. This whole thing of the last 2 years is just really consolidation that will hopefully lead to a breakout that goes higher. But that's what breakouts do. They take years. You know, here's in fact, look, you got this one, and we consolidated, pull back pretty drastically, came all the way back up here, tested the line again, went back and consolidated some more, and then eventually, boom, finally you go higher. Then we're consolidating for a long time, and now higher, and now we're going to consolidate probably for a long time. But nobody has patience for consolidation, and people act like, how do you act like this is the end of the world? This is what happened to us just recently. And everybody freaks out and thinks it's like some horrible thing. It's just a normal pullback. There's nothing to it. People overbuy stocks and pay too much and overvalue things, and then they come back to reality. But if the reality turns out to be better than the old reality, then the market will sustain itself and keep growing. Now here, look, this is the insanity of the 1999 bubble. Things never should have been priced this high. Okay? So then they corrected. Then they went up again to the same place they were in 2007, and that turned out to be based on a lot of fake earnings that were coming through. And this is, by the way, where we are now is nothing like where we were then, because where we were here was the real estate bubble in 2006, 7, 8. And there was a housing bubble and a commercial real estate bubble, and everybody was overpaying for everything because they thought that the housing was going to go up and up and up and up, and the commercial real estate was going to go up and up and up and up. And obviously it was unrealistic because, as I would say to people at the time, I'm like, where are these people going to be? How many houses can people own? It's a fact of life that you have an average family size is 3.2 people in America. So you only need 110 million homes, or about 110 million homes to house everyone in the country. Once you get past 110 million homes, you have too many homes. Unless you're like suddenly growing your population faster, you have too many homes. So where is the inherent value in building more homes? And then you have to look and say, well, are we tearing down the old ones? If we're not tearing down the old ones and we're building new ones, we're going to end up with too many homes. It's not a complicated process. Now, there are factors like household creation. And by the way, another factor that's holding back the housing crisis is that you're kicking all the immigrants out. If you kick all the immigrants out, there's empty homes. And you're creating more availability of real estate. And it's hard to see it on a macro picture. Everybody looks at their local market, but your local market can be affected by dozens of factors. You have to look at like the really big picture and how the United States is housing-wise. For example, North Dakota is paying people like $10,000 to move there. There are states in this country that are desperate for people. Alaska is desperate for people. They don't have enough people to go live there, while other parts of the country are way too crowded. And to me, the solution to the immigration crisis is to say to people at the border, basically when you cross the border into the United States, there should be a bus waiting there to take you to frickin' North Dakota and Alaska and say, yeah, we do need people in these states. There are certain places we need people. Go there. Parts of California need obviously they always need migrant farmers. Parts of California need farmers. Build communities out there. Let people live out there. You have very, very depressed areas in Northern California that would benefit from having immigrant populations come in. Immigrants are not a problem. The problem is completely is randomly allowing them to come to the States. It's a problem when well, I don't think it's a problem. I mean, it's a problem in an allocation of resources thing. Because if you look at like today, home, oops, got to log in. Because I just put a chart up of that in the chat today. Oh. Where was that? Oh, here. So, Miami is now 69% Hispanic. So, not that there's anything wrong with it. It's fine. It's a Spanish city, so what? But the point is that there are places where you want to have people go. Everyone shouldn't just go to Miami. Come to the country. Miami doesn't need more people. Miami's very crowded. It doesn't need more. And not only that, but Miami's going to be underwater in a certain. That would be interesting. For all these people from Miami, people worry about immigrants. Imagine the immigrants are going to be leaving Miami to go to places where it's not flooded in the next 20 years. Because Miami will be underwater in about 30 years completely. So, I guess they'll build walls or something, but to keep the water out. But we'll see. But there are places in this country that desperately need people, and you should look at the immigrants or people who want to come here as a resource and say, hey, you are welcome to come to this country if you promise to live here. And you give them conditional papers and say, hey, you are authorized to live here in this country. After you put in 10 years in North Dakota, then you can go wherever you want. But first of all, establish yourself as a useful citizen, get a job, so on and so forth. If we did that, if we gave probationary papers out and let people put themselves into society and work and create more boost for the economy and stuff, there'd be nothing wrong with that. It's not the immigration that's a problem. It's a lack of policy of what to do with the immigrants that's a problem. That's where we're failing. And it doesn't fix it to close the borders and so on and so forth. It's good to have more people in this country. We're not growing our own population very well. U.S. population growth. So we have 330 million people as of Monday. That's interesting. Oh, they have a ticker. That's funny. Why can't you just tell me how much it's growing? Is the U.S. overpopulated in 2019? That's a weird question. Let's see if it shows growth at all. Oh, here. Oh, okay, good. All right, so 326 last year, and now we're up at 329. So 3 million people gained in the United States. And let's see, that's 2017, 324, 326, 329, 322, 319. So we had like 2-3 million people a year. So we're growing about 1%. So that's not very much growth. And also the other thing is, though, you want younger people in. You want younger people of working age to support the Social Security and things like that. We're not doing that either. We're an aging population. We're going to be in big trouble like Japan. Not as bad as Japan, but bad. Let's see if it shows that also. Yearly population gravity. I don't even know what that is. Oh, that's the growth rate. Okay. Oh, well, there you go. Okay. So there's your growth rate. Look what's happened to us. We used to, when this country, well, the funny thing is talking about Make America Great Again. When America was theoretically great, we were growing at almost 2%. We've gone down and down and down, and now we're like here. That's scary. That's a really low number. Not showing anything useful there otherwise, though. So, and this country used to be, obviously, with all immigrants, we used to have, everybody used to come into this country. And it's not necessarily good for the country not to have people coming in from other places. So let's see, 52%. Okay, so half the population growth is Hispanics. And countries with the 20 fastest growing populations. That's interesting. Who's got the fastest growing populations? Ugh, go away. Oh, for God's sake. I can't take the internet anymore. It's so annoying. You can't get on any sites without, like, it wants to disable your ad blockers and this and that. Fastest growing populations are we going to tell me anything useful here? No, this is a terrible slide. Okay, well, sorry. Wasn't as good as I thought. But anyhow, so what were we talking about? Let's see if we have any questions before I move on. Nope, nobody has questions. That's good. All right. Ugh. And Powell is officially done at this point, I think. It's talking to Maxine Waters about something. I don't think she's talking to Powell, though. She seems to be talking to the camera. So I'm sure he's done by now. That was a long testimony, though, for him. So, if we're having slow population growth, that also goes towards how much energy we're going to use and the resources we're going to use and so on and so forth. All those things come into play. And oil's creeping above 60. These guys creeped up a little bit. Gasoline's still just barely under $2, and we'll see what happens. But it's actually good for our UGA play if it pops over, but I think it's going to go down a bit from there. But, we're back to almost the highs on the indexes, so things are looking pretty good here. And we'll see if we can maintain it. We talked about some hedging. What else did we talk about today that was important? We were talking about inflation and where, look, see, we're at, well, you are here on inflation. Now, see, look, this is interesting because you forget about this. We had deflation in the 20s, in the 20s and the 30s. We had deflation. I imagine this must be 1930. I'm not sure exactly what that dot is. But anyway, so somewhere, the market crashed, we had deflation, prices went down for a couple of years, and they came back and whatever, and then we have inflation. Then here's where we went off the gold standard in 1972, and that led to, it's technically not hyperinflation. Hyperinflation has a definition of being like more than 20%. We never had that in America, but even 5% to 10% growth, which is what China has on a regular basis, even that kind of growth, you grow your way out of debt pretty quickly. All you have to do is stop borrowing money a bit, and your GDP will catch up to how much money you owe, and it becomes a smaller percentage. So that's what happened to us in the 70s when we got into a manageable range. But since then, when Reagan came in and said, "Oh, look at all this! Look how much GDP we have to debt. Why don't we just borrow some money?" So he stopped taxing corporations, stopped taxing the top 10%, and our debt started exploding again. And it's just gone up and up since. We had that. Then Clinton came in and said, "No, this is a mistake. We shouldn't do that." And then, of course, Bush comes in, and after Bush, Obama, who didn't, it was a crisis when Obama came in, so he had to spend the money. So we just had, debt. It started flattening out here. Now Trump has pushed it. We are above this line now. We're above 120% of debt to GDP. And that's still half of where Japan is. Japan is 250% of their debt to GDP. Now, you could look at that optimistically and say, well, geez, then we have an open checkbook. If Japan can survive with 250% debt to GDP, then doesn't that indicate that we are able to spend another $20 trillion before we're in big trouble? 22, we're 22 trillion in debt. So are we going to be able to spend $22 trillion before we get in trouble, since Japan is clearly not really in trouble yet? But the problem is Japan is doing it in a vacuum. They're the only ones who are at that level. They're also a relatively small economy, not small, but I mean, they're a $5 trillion economy, half of China, 1/4 of Europe, 1/4 of our economy. So there are much bigger economies out there, and Japan is not by itself going to topple things. But what if everybody goes 250% of their GDP in debt? You know, it's just insane. You know, we can't do it, and China can't do it. It's a terrible, terrible idea. And but that's the way we're heading, because we're basically so the logic that's being used by our politicians and such is to say, well, you know, hey, Japan's 250% in debt, so why can't we be 250% in debt? You can't be, because the world can barely afford to sustain Japan at this kind of debt level. And if we start doing it, and China starts doing it, and Europe starts doing it, it's going to be a complete disaster. It will not be sustainable. It's barely sustainable now with just Japan doing it. And Japan's in a very unique situation because all of Asia considers Japan a safe haven economy, and they will buy Japanese bonds even at negative rates because they are safer than, or considered safer than, China bonds or whatever. You know, people don't want to keep all their money in Chinese currency. People don't want to keep all their money in Vietnamese currency or South Korean currency. They all have various degrees of instability that worry people, while Japan is generally looked at as a very, very stable government. I'm not sure if that's true. I'm not sure if that's sustainable. Okay, well, it's all a big experiment to see what happens. And if we fail this experiment, it's going to get very, very ugly. So I am concerned. But like I said, it's just one of those things that can go wrong in the near future. It won't take much. I mean, the way Japan is now, I think about 40% of their government's income, all the money all their money they collect for taxes and so on and so forth, 40% of that goes to paying their debt service. It doesn't, so if debt, you know, and their average rates are less than 1% on their debt. So if rates go up to 2%, 3%, don't forget Greece hit 20% when they had to borrow money. Japan can't pay back 20% money. Japan can't pay back 10% money. They're barely paying back 1% money. It's taking 40% of their GDP to service their debt. I'm sorry, 40% of their revenues to service their debt. So that means, you know, 40% of the money goes to service debt, 60% goes to run the government. If the debt service doubles, then the money to run government is cut by 2/3. And anything past that, they're completely running a deficit. And at that point, investors would quickly lose faith, and you do become Greece. That's what happened to Greece. Greece was taking in less money than the debt service was costing them, and everybody looks at that and says, why would I lend Greece money? It's incredibly risky. And then rates started going up and up and up, and that becomes worse. And then it costs them more money to service their debt. And if you can't get the money out of your people, if your people aren't rich enough to take the money from, you got nowhere to go. And Greece sold off their assets. They privatized their post office. They privatized their utility companies. They sold off everything they could, still not enough money. And you can quickly drive a country into bankruptcy like that. Japan is not a big country, size-wise, doesn't have a lot of resources, doesn't have really anything to sell and have things to bargain with. They really only have their manufacturing-based economy. It's very strong, very powerful, creates a huge amount of income. $5 trillion GDP for a small country like that is fantastic. But it's teetering on a knife edge, more so than anywhere else in the world. And the rest of the world shouldn't be aspiring to be Japan. Japan is supposed to be the cautionary tale that you shouldn't try to be like. But instead, we are all heading that way with debt. It's very scary. And Powell's thing, today what Powell was saying was really that he's not that worried about where we're going. He said in the near future, we don't have a problem. But that's based on that logic. It's based on the logic to say that Japan can do it, so can everybody else. And that's crazy. It's hey, it's like let's say you get 10 pizzas and one guy eats 3 pizzas, right? You get 10 pizzas for 20 people, and you say, well, that's got to be plenty. Say half a pizza each. But one guy eats 3 pizzas. If everybody eats 3 pizzas, you don't have enough pizza, even though it seems like quite a lot of pizza. You can't have everybody follow the worst case scenario. It doesn't work that way. If one guy does it, then the other 19 people are sharing 8 pizzas, and they still get a couple of slices each, which is fine. That's fine for normal people. But if just one more guy says, I'm going to eat 3 pizzas too, now you have 6 pizzas. Now you have 4 pizzas left for 18 people. And I can't even do the math, but maybe 4 times 8 is 30. So you have 32 slices for 18 people. You still almost have 2 slices each. So one guy can have 3 pizzas. 2 guys can have 3 pizzas, because you're always going to have a girl who's going to eat 1 slice. There's going to have a couple of girls there who eat like a slice, and they go, oh, that was great, I'm done, which I can never understand. But then once the third person eats 3 pizzas, now you have one pizza left for 17 people. Clearly not enough pizza, no matter what you want to think. That's what debt is. There's only so much debt in the world. You can always make more debt, but not really, because somebody's got to lend that money. The money has to be there to be lent. But somewhere, somehow, money has to be created for you to go in debt. And that's what's going on now. Is what's happening to a large extent is the central banks are printing money, creating money out of nowhere, and lending it to each other, which does not help the GDP. It doesn't boost the GDP. If we print $1 trillion and lend the $1 trillion to Japan, that doesn't help anybody's GDP. It helps the GDP when a person who works creates value with the work that they do. They are paid for that value from money that's been created somewhere. They have money. They then put that money to use in the economy, and some of that money goes to buy the Japanese bonds and whatever. That's good money. That's a good way to create money. And that boosts the economy because it goes through the economy before it gets to Japan. What we're doing now is we just have central banks printing money and lending it to each other. And that's why you have this, not that. Wait, really? I had such a good chart. That's why you have a massive increase in the money supply, but a decrease in the velocity of money. In other words, the money's not changing hands because it's getting printed and put right in the bank. And that also includes the money that goes to rich people, the money that goes to the top 1%. They put it right in the bank. They don't spend it. Jeff Bezos made $100 billion in the last 10 years. Okay, he didn't have $1 billion. Now he has 100 and something billion dollars. He made $100 billion in 10 years. He hasn't spent any of it effectively. He has all the money he made. It went right in the bank. It's not doing anything for anybody. It's $100 billion of somebody's money, of people, people who invested and have stocks, whatever. They put money into his company, and his value, his stocks went up. He's got 100 billion brand new dollars, but he's not spending them. That's where the supply of money goes up and the velocity goes down. He's sitting on his money. Well, a lot of rich people sit on their money. You give them more money, they put more money in the bank. You give them more money, they put more money in the bank. It's not like the people who are billionaires, they already have pretty much everything they want. Even Donald Trump, who has a gold bathroom and a penthouse is like, you ever see his apartment? His whole apartment is like gold plated. Even a guy like that, there's only so much you can buy. After a while, it's like, what are you going to buy now? Unless you're just spending money you have to purposely spend money, and that gets boring. That's like a job. So unless you're just purposely out there spending your money as much as you possibly can, it's going to start accumulating on you. And these guys just get richer and richer and richer. The concentration of money. In fact, Powell talked about that today. He said it's a problem. The inequality in the country, Powell said, is a problem and is getting worse. So we will have to see what happens. Anyway, so velocity of money, right? So you're not going to get any real inflation unless the velocity of money changes. The velocity of money changes when people start buying homes again in decent amounts, and they're not. That's not happening. But one thing you got to watch out for, which I had another chart of, wages. Wait. Where is it? We're not really seeing wages go up yet, but look what's happening here. Job leavers. These are people who are quitting their jobs. Okay, the quit rate, what they say. The quit rate is up to 10%. That's a lot. 1 out of 10 people are quitting their jobs. So that's the highest it's been. That means people are very confident that they can make more money somewhere else. And that's, well, wait. Fed funds rate. Was the Fed funds rate? Yeah, I guess it was this high. Okay. A little confusing. I'm not sure which side is which, but anyway, so it's a huge, I think, share of jobs, quit rate left. Oh, I'm sorry, quit rate. So quit rate is 15%. That means 1 in 6 people, 1 in 6 are quitting their jobs and going for better jobs. So they expect more money. Employees are expecting more money. And by the way, that's why when you hear all this thing about the $15 minimum wages and whatever, the reason you're not getting a huge resistance that you would expect from the conservatives, from the right, is because they know they're facing the reality that nobody's taking a job for $10 an hour anymore. They have to raise the minimum wage. And if one guy capitulates, he'd rather have it where it's forced on everybody. So in other words, if one guy says, I can't hire people for $9 anymore, I got to pay 12, 15, or nobody's going to come work for me. He would rather have the minimum wage be 12 or 15 because that way at least he's not the only one paying. That his competition has to pay the same as he does. Everybody's always worried they're being out-competed, right? If you have a restaurant and you're hiring people at 15 and your guy down the street who competes with you for prices is hiring people at 10, he's going to have a competitive advantage now. Realistically in the market, that's not how it works, but it feels that way when you're the guy who has to capitulate and pay 15. When you're the one that's facing the pressure, individually making your own store decision, you feel like that's something that's happening to you, not necessarily everyone else. You'd rather see all the rates go up so that you're paying in line with what everyone else is paying, and nobody's going to be able to undercut you based on paying lower wages. Now, we were talking yesterday in the chat room about, does a higher minimum wage encourage automation? And obviously you can make that argument throughout human history, right? I mean, the wheel came along and that replaced a certain amount of workers. And then we had the Industrial Revolution where there were people who actually broke the machines. The Luddites would break the machines because they said these machines are costing us jobs. So they're replacing factory workers at an alarming rate. So yeah, of course that does happen. You know, machines will replace workers, and the more you pay the workers, the more worth it is to have the machines. But as I noted yesterday, Walmart has 2.2 million workers. And I'm going to show you the math. It's important to understand this. So Walmart has 2.2 million workers working 40 hours a week. And if they get paid, instead of $9 an hour, they get paid $16 an hour. That's $528 million per week. More money Walmart has to spend. $528 million a week times 52 weeks is $27 billion per year of additional wages going to those 2.2 million people. All right? If you don't pay them that money, that's $27 billion Walmart has to buy machines anyway. It's not like they're not going to buy the machines. They're going to buy the machines. They're going to automate those jobs out of existence. For the meantime, while they still need the workers, at least some good will come of it, and the money will go to the workers for a little while. And it may even delay how fast Walmart can buy all the machines they need. But the math between, in other words, when you're replacing a worker, all right, let's do this math. Okay, you have a worker who's costing you $9 times 40 hours a week times 52 weeks. You have a worker costing you $18,000 at $9 an hour, right? And if you pay him $15 an hour times 40 hours a week times 52 weeks, it's $31,000, $13,000 more for the same worker. If you give them the raise, that's quite a lot. So Walmart's goal is going to be to halve the number of workers. But if they're buying, so halving the number of workers is going to save them, either get them back to where they are now salary-wise, or if they do it now, if they save the half now, they're still going to save $13,000 times half on a worker. And if the machine that replaces the worker costs, let's say, costs $500,000, and you pay for the machine, let's say you have a machine for $500,000 replaces 5 workers, and you pay the machine out over 5 years, so it's $100,000 a year to replace the 5 workers. All right, and if you raise the rate of the workers, if the workers now are getting $18,000 and you're going to raise their minimum wage to $30,000, you've gone from basically breaking even on what Walmart's going to replace the machine to making it make sense for them to get the machine. So in other words, if you're paying the guys $30,000 each for 5 workers, it's $150,000. So where Walmart might look at it now and say, well, I'm going to spend $500,000 to replace 5 workers because it really doesn't cost me more than that for 5 workers. But Walmart still looks ahead to inflation and so on and so forth. And there's a certain inflection point you hit at which the machine becomes cost effective enough for Walmart to buy it anyway. It's not whether they spend it's not whether they save $50,000 or $5,000. If the company can save $5,000, they will save $5,000. It doesn't change their decision-making process. It just makes it more cost-effective for them to do so. But it's going to happen either way. Either way, these guys are going to get replaced as fast as they can. As soon as it's cost-effective to replace workers, they'll replace workers. So to some extent, yeah, raising the minimum wage does hasten that decision-making process, possibly for corporations. But on the other hand, the benefits outweigh those risks. And the CBO, the budget office, just did a whole study and said, yeah, you know what? It's really not going to change the job picture very much. There will be slightly less jobs created at the higher minimum wage, but it won't really affect the big picture. And the difference is obviously the benefit of people getting $18,000 a year or $30,000 a year is night and day. You can't live on $18,000 a year, especially when it's your gross salary and your take home is something like 14 or 15 maybe. I don't even know if it's 15, but let's say your take home is $15,000. That's $1,200 a month. Who the hell's going to live on that? And I know people like to say, oh, those are only part-time jobs and blah, 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 blah. That's not true. Go to Walmart. Look at what 2.2 million people do for a living. Who are these people? They're not children. These are people. These are real human beings, adult people who have jobs. And that's what they depend on to live. It's just ridiculous. So anyway, so the bottom line is, though, these people are now quitting their jobs because it's not enough money. And there are jobs out there that will pay them $15. And that's why the minimum wage is going up. More so than anything else, so the minimum wage is going up because people are willing to quit their jobs. Back here, nobody was quitting their job. Look at the quit rate, 0 or 5% turnover, whatever. But nobody's quitting their jobs in a recession. Now the economy is doing well and people are quitting. The only way you can stop people from quitting is to raise the rates. Now you're competing. Now the employees are competing for laborers. And I remember that. I went through this cycle too. And I've been in that cycle. When I started working here, look at the quit rate here. When I came out of college in the 80s, If I didn't get a 10% raise, I'd quit. It was insulting. Every single year, you expected a 10% raise in the 80s. You had to keep up with, for one thing, you're only keeping up with inflation anyway. But you just expected any job you're doing, if you're doing your job, you'd get it. If I didn't get it, I would quit and go get another job because you can get a better job that pays you more. And the employees had to do that. That was how it works. We're getting there. We're not there yet. So the Fed can't lower rates and have this and have this go up. That's wage inflation. There's nothing worse from the Fed standpoint. There's nothing worse than wage inflation. That's the scariest kind of inflation because wage inflation does exactly. Well, it's good. It's good for humans. It's bad for the economy. It's bad for corporations. Wage inflation puts money in the pockets of the people who spend it and increases the velocity of money. See how it all ties in? It increases the velocity of money when you give the workers more money. They spend more money. It increases the velocity. We already have a huge supply of money. And what you're doing with wage inflation is you're forcing the supply of money to come out of the hands of the top 1% and put it into the pocket of their workers who will spend it. So the money goes from banks into circulation and begins to be spent, and the GDP in the economy accelerates, but it's inflationary. And that's where we're heading. Now, inflationary is not bad for stocks because the stock is based on the price of the goods and the profits. And if you don't get heavily hit by margin, that's why tech, by the way, is very popular. Tech companies aren't as employee intensive as other companies. So if you're not getting chewed up on your margins as inflation kicks in, then you will make more money. Basically, the prices you charge for your goods and services goes up. Your profits increase in an inflationary manner, whether or not it increases because you're growing your business isn't important. It's the fact that the bottom line number profit is getting bigger. And if your profits are growing, you get rewarded in the stock market. And that is the beneficial way in which I see the S&P going above 3,000 and the market's continuing a long-term rally. Is an inflation, the next big stage of a rally is going to be an inflationary stage. That's the bottom line. And that's where we're headed. And the Fed keeping an easy policy in the face of what is clearly a very much tightening job market it's going to accelerate that process. So we will see. And at the moment they say, oh, inflation is still very low, but it can kick up real fast. Inflation is low because there's no velocity of money. Because you're giving money to the wrong people. You're giving money to people who don't spend it. When you start giving money to people who spend it, that velocity is going to kick up real fast. The supply is still out there, and we're going to get some real big inflation numbers. So that's something definitely you want to keep your eye on. And that, by the way, crashes the bond market because the bond market is fixed. So if you have a 30-year 2% bond and inflation is 5%, that means every year you're losing 3% to inflation. So over the course of 30 years, your bond is worthless. So you have to remember that also. Oh, the Fed minutes, shit. I forgot about that. All right, so the Fed minutes, I'll take a look and see what that says. Any interesting trade ideas for UNG or natural gas? Natural gas is weird, but we'll talk about that next. The Fed minutes, let's see. I don't want to read the Fed minutes. Let's look at the Wall Street Journal. Let's be lazy. We have the Wall Street Journal. I'm in no mood to read the entire Fed minutes. Powell, come on, whoop. See, this is their interpretation that Powell is setting the stage for a rate cut. The minutes, What, really? Oh, for God's sake. Gotta go to Twitter to find out the news. FOMC minutes. Well, the Fed's talking on Twitter. That's funny. Members see case of rate cut strengthening. Members see accommodative path warranted going forward. Several members still see rate cut as a risk to financial imbalances. Okay, strongest signal yet for a cut in July. Many officials saw more Fed accommodation warranted in the near term. All right, that doesn't help. Oh, I see. Oh, that's cute. That's from the Bloomberg terminal. Stronger case for rate cut. Officials saw accommodations. No decision taken June for standing. Fed staff gave presentation. Inflation expectations inconsistent. Several officials didn't yet see a strong rate cut. Several officials saw a near-term cut as a cushion for perceived problems. But see, we're not. You have to put it in context. This is from the June meeting when the trade war thing was heating up, and they were worried that we were going to have a full blowout with China that was going to derail the economy. Everyone loses the context when they look at the minutes, because you have to remember when the meeting was. It was June 18th. The world was different on June 18th. We were much more worried about a trade war creating a massive imbalance in the economy. So more Fed members saw a case to make a cut. That doesn't mean that that still happened. Since then, we have the G20 meeting, and everybody seemed to be making nice. And there's no reason at this exact moment to say a cut is necessary. They should be ready to cut, but that doesn't mean if they're ready to cut, doesn't mean they will cut. Participants judge that uncertainties and risks had increased significantly over the recent weeks. They have decreased significantly over the weeks since then. So many said they saw a stronger case. So even given that the fact on June 18th we were in bad shape, we were very worried about China, the Iran thing was heating up, all kinds of problems were going on. At that time, even then, only maybe 2/3 of the Fed officials thought that it was time to raise rates, or they should be ready to raise rates. So since then, if you lost half of those guys, then it would have swung over to where they're not going to raise rates. So I don't see it being realistic. I don't see this is what's happening. So let's see what this guy says. Powell shrugged off good news today, happy to promote the more pessimistic side. However, eyes remain on the FOMC for more signs of dovish spreading across the Fed members. So it very much depends on what the Fed members say at this point. Powell's testimony today, uber dovish outweighs the month-old meeting minutes. So effectively, everybody's spinning what Powell said as being very dovish. I did not see it that way. I saw him saying they're still data dependent. And I think he's trying to ease people into the concept that we're not necessarily going to have this cut, but that's not the way the market's reacting. The market's reacting as if he gave it the green light. And look, we're right at 3,000. We have another chance to short. The last short was 10 points, which was $500 on the S&P. Very simple. Below the line short, above the line don't short. That's all there is to it. It's very easy to play. All right. So Eric says, any trade ideas for UNG? UNG is very weird right now. It's not as low in the channel as we'd like it, so it's not a good time to play. So you say a trade idea. My trade idea for UNG is not to play. We have an incredible supply of natural gas in this country, but we don't have the means to extract it. Actually, that's pretty low still. My mistake. All right. So yeah, we are still pretty low, but we have a massive supply of natural gas. We just don't have a good way to get the natural gas from where it is out to the market because we don't have enough pipelines and infrastructure there. but supply-wise, we have so much natural gas that you got to be careful about going too heavily into it. Long term, though, I do think at certain points it'll spike. We'll have storms this season. We've had very, very warm waters, which is like an El Nino thing, when you can get a lot of hurricanes coming in because the waters are very warm, and that disrupts the natural gas supplies from the Gulf Coast and things like that. Although these days, most of our natural gas comes from shale, which is not really necessarily affected by the same hurricanes. But still, 243 is pretty low on natural gas, and we can expect something to move us back over 250, 260, something like that. So if you're looking for like a little gain like that, sure, play the long-term UNGs into next summer, the 2020 contract, so you have plenty of time for hurricane season to play out. And also, obviously, there's the ETF for the UNG ETF, which is UNG. And that you can play, well, you don't want to go to 2021 with that. If you go over here, they did a, let's see, where are they at? They're at 21 now, and you can pick up. Now, when I'm looking for a price, I look at where the 20s are. The 20s are 275. Then it costs you 325, so 50 cents to go down a buck is worth it. If these are 325 and these are 380, still kind of worth it. So let's say these are 380, and then these are 450. At 70 cents is no longer worth it. So you can pick up the $18 calls for 380, and then you want to sell something that has good premium. So you can sell the 22s, and it's the opposite of what we were doing. Before, we were willing to go lower for 50 cents. Now we're willing to go higher for less than 50 cents, but we're not going to spend 50 cents to go higher. So 190, you're still going to get 160 here. That's still worth it. Here you're getting 130. And then we also have to be realistic about how high we think UNG can go. It's probably not going to go much more than 10% higher. So 10% higher is 21.23. So right about here is the sweet spot, 155 and 135, or 160 and 135. And how much were these? These are going to be, the 18s are going to be 380. I think I would go with the 1823s. So it's 380 for the 18s minus 160 for the 23s. So you're in for 220 on a $5 spread, and against that you could sell, like the $20 puts for $1.70, and that would drop your net down to what do we say, 220? That'll drop your net down to 50 cents on the $5 spread. So that's the way to go. You just got to be careful that you don't mind owning natural gas long term if it gets assigned to you down the road. But you're basically selling the $20 put, so anything above 20 is fine. You're calling the bottom here, and then you're picking up the $5 spread that's already a good part of it's in the money. So I like that spread if you're going to play natural gas. There's just no pressing reason to play it right this minute, but if you're going to play it, that's the way I would play it. What was the other question somebody had? The best hedge if you're buying today. Well, if you want to figure out the best hedge, what you got to do is you first of all look for like what index is the highest, which index has gone the furthest up, and based on that, you want to say, well, which one has the furthest to fall? You also look historically how far down do they go. So the Nasdaq's up more than 10%. The S&P is up not as much. It's up because 10% would be 300 points. It's not up 300 points. 10% on the Dow would be 2750, and it's not up 10% either. 10%'s up here. So the Nasdaq is winning so far. It's up more than 10%, and the Russell 1460 and 1570 is also not 10%. So the NASDAQ has the furthest to fall, but then you have to start considering, we went through this exercise last quarter, is the NASDAQ likely to fall? And to look at that, you have to look at the stocks in the NASDAQ, especially Apple, and say, is Apple likely to fall? Well, if Apple does fall, it sure as hell would take the NASDAQ with it. I think that Apple doesn't have that much further to rise, so that's helpful also. And then you have to think about the rest of the NASDAQ stocks and were they overvalued. And clearly, Amazon's overvalued, Netflix is overvalued. So I still like the SQQs. That's the bottom line. And we are aggressively short the SQQs in our portfolios. And not necessarily that you have to go that aggressively. In fact, let's look at the OOP in the options opportunity portfolio, which this is the options opportunity portfolio. Our SQQ position is we have the January 35.50 bull call spread. Now that's actually not that aggressive, but keep in mind that SQQ is a 3 times ETF. So it's now at 32. If the NASDAQ drops 10%, it goes up 30%. So it'll be at 40, about 42. So here's your target for SQQ on a 10% drop in the NASDAQ is about 42.50. So if you want to play it and hedge it now, you want to look for something that's going to pay you off at 42.50. And then it's a question of time frame. But let's say we go to January and we look at the price of the $42 calls, which is 270, or see, you're not going to get, the old one was 320. Here you'll get 270. Here you're not going to get, obviously, 320. You're going to get more like 280. So I would certainly sell these for 270 rather than these. You could sell the higher ones. They also have great premium. Look how slowly they drop off in price. These are still 230 or 225, but it's an unrealistic target. So you have to weigh that out. It's like, why would I not collect 50 cents when I don't think it's going to go to 45? So at 42, you're going to collect 270. Now, what do you have to buy to offset that? Well, we're at 32 now. And if you bought these for 470, the 32 calls for 470, and you sell the 42s for 270, now you're in $2 on the $10 spread. So you can make that you make 400% profit if it goes into the money. And you can offset that by short selling something. You could short sell half of the $30 puts, but then you're making a very strong stand that the NASDAQ won't go higher by the end of the year. Or you can find a bullish offset that you want to bet, that you would like to bet the puts on. So something like selling Apple puts. So in other words, if the NASDAQ doesn't go down, well, then it's not likely Apple's going to go down. And if you go to January and you sold the 180 puts on Apple for 550, you wouldn't have to sell very many of those, and you could buy a lot of the other spreads because the spreads are $2. So let's say you bought 5 of those spreads for every one short of the Apple. So the 5 spreads would cost you $10, less 550 here, so you'd be spending only $450 per 5 long spreads, and that would be less than $1 per spread. So what would your bet be? Your bet would be that Apple's not going to go lower than 180, and if it does, you'd have to roll in. Of course, obviously, you've got to be able to deal with being short Apple at that point, if that's what being long Apple at that point. So unless you really like Apple, you shouldn't do that. But it goes for any stock you want to do. So you can offset your cost by selling puts in something you wanted to. And in fact, yesterday in our chat room, we sold 4 different puts in the short-term portfolio, which were Home. I don't remember, but I'll look. I know one was Macy's. Wow, what was that? 4%. Put. So this is what we sold yesterday to raise some money in the short-term portfolio. We sold some IMAX puts I think IMAX is ridiculously underpriced here. I wrote a whole thing in the top trade alerts about IMAX. How are you doing today? Where are my things? Ugh, nothing. And Macy's, nothing. So these aren't doing so good. So we had WBA. Obviously, not that I expect them to do good the next day, but just checking. So WBA is going nowhere. Wow, these are really not performing. And BBY, and that's Bed Bath & Beyond, not Best Buy. BBBY, also having a blah day. So everybody's having a blah day, which means you can still get the prices up. So we liked IMAX $20 puts. Walgreens Boots, I think, is stupidly priced low, and so we picked up those. Intel, also cheap. They've got their new chipset is going to be gigantic. And this happens to Intel all the time. Whenever they're between chipsets, you know, they spend years of R&D. They put out some chips. Those chips sell like crazy, and then they cycle down. But while they're cycling down, Intel goes back to their R&D phase. Now the problem is, though, of course, when Intel cycles down their R&D and starts selling chips, profit margins expand. When the chip cycle ends, the chips start getting cheaper. They discount the chips, and they are at the same time phasing up their R&D, spending more money, and their margins contract. It's a cyclical chip business. That's how it works. But people freak out every time as if it's over for Intel. I mean, literally, we've had this discussion ever since I started PhilStockWorld. I have the same conversation with people over and over again about Intel. It's like when it's cheap, you buy them. When it's expensive, you sell them. It's not complicated. You know, so here they are back down in the channel. Not terribly down, but they're down in the channel, and their new chip cycle is coming now. Their brand new chips are amazing, and they're going to sell like crazy. You know, you're not going to have, you know, people, it's funny because people don't understand, like, yeah, not as many people have laptops and stuff now or depend on them the way they used to, but on the other hand, what do you think a robot works on? What do you think a car works on? Instead of everybody having a laptop now, you've got a computer chips in your car, not even just one, you have computer chips in your home, you know, and the controlling chips are Intel chips. You know, you need real, serious, powerful chips for a lot of these things. So a lot of these chips are still being sold by Intel. The highest end chips, the ones that are going to power your car and power your robot, are definitely Intel chips. You know, these aren't joke chips. You know, anything a robot's going to operate, it needs an intensely powerful computer to run it, and possibly more than one. So Intel is going to make phenomenal amounts of money with their new chipsets, and they're designed for the Internet of Things. They're designed to be the controlling hub for many devices. You know, and that goes for autonomous drones and all sorts of things that are going up. So, you know, there's going to be a whole new cycle of chip buying, but not by people. And people still think they're like, oh, well, I don't own a laptop, or I don't buy a computer anymore, therefore Intel is useless. That is so not the case. Think of all those kiosks at McDonald's and all the, you know, like they've all got Intel chips. They're all running on computers. Every cashier station has chips and Intel chips and so on and so forth. It's not just Intel, but I mean a lot of people. But believe me, Intel's going to get their share. So anyway, so they're still cheap, and we like Intel. And then Bed Bath & Beyond also just stupidly cheap, ridiculously low prices for this company. They have earnings, I think today. Let's see. BBBY. Yeah, so we'll find out tonight. But they're in a restructuring. You know, we're not expecting any great things, but they are very stupidly cheap. Financials. Where is it? Okay. See other income expenses net, right? So you can see 87, 69, 82. They took a huge charge here. Okay, if they hadn't taken that charge, which is $500 million more than normal, they would have had the normal profit of about $400 million. But they didn't. They took a restructuring charge. So last quarter sucked, obviously. It's going to impact the whole year. So even if they make what they made last year in 3 more quarters, which is 8, 14, 4, 20, so they're going to only make, because of this loss here, they're going to make only, well, this is 2 billion. No, it's not 2 billion. It's 1.9 billion, let's say. There's 1.9 billion, so they're going to only make 1.7 billion. But you know what? You're buying the whole company for $1.5 billion. So and again, let's look at the financials again. Those are millions of dollars. Oh, I'm sorry, that's for the year. Sorry, my mistake. That's for the year. So for the whole year, I'm sorry, there'll be $300 million, and you can buy the whole company for $1.5 million. So they're going to make $300 million, and you can buy them for $1.5 billion. That's 5 times earnings. And the analysts say they're going to make $2 a share this year. Well, it's hard to say what 2020 is for these guys, but anyway, they're going to make $2 a share in 2020 and $2 a share in 2022. And again, these shares are $11.48. PE below 6. It's just ridiculous how oversold things can get because people panic out of perfectly good stocks. So what do we do in the short-term portfolio? We sell these puts and we collect $26,700 to offset. So in other words, if the market doesn't go down, and all of these are below the current prices. So all the market has to do is not go down. Oh, I'm sorry, Best Buy is aggressive. But if the market doesn't go down, the puts expire worthless and we keep $27,000. That then offsets some of the cost of our hedges. That's how we lower the cost of our hedges. It's the same thing when you're buying a bull call spread and you want to lower the cost. You pay, especially when it's a hedge, you're going to offset the cost of your hedge by selling something that if the market, if your hedge doesn't pay off, if your hedge fails, then the market is probably flat, and then if the market's flat, it's very unlikely that the stock you buy is going to go down. But if it does go down, you don't mind owning it at the net price. So those are the conditionals for picking something. So it doesn't have to be Apple, it could be any of these stocks that you believe in, that you don't mind having in your portfolio if push comes to shove. And don't forget though, if your hedge does well and goes in the money, it's possible the whole market's tanking, and whether or not it's for good reasons, you may end up getting assigned these stocks and owning them. So it has to be something that fits in your portfolio if you're going to sell short puts. You can't just do it to collect the cash. There are real consequences to owning these things. And Ken says he did cover earnings BBBY puts, so let's hope earnings go well, because that's a definite one I like a lot. I think those are very good price for puts. I mean, look at the net. The net on that is $8.50. The stock is currently $11.50. If you just do that, your worst case scenario, just selling the puts, you're collecting $4 against a $12.50 put, and your net is going to be $8.50. So your worst case is getting $3 off the current price of Best Buy. That's like a 25% discount. That is your worst case scenario when you sell these puts. That's not a bad worst case scenario. That's why I like to do these things. It's worth it. And we don't mind owning Best Buy at $8.50. So in other words, if I would love to own Best Buy for $8.50, then this is free money, right? I'm just getting $4 for no reason. Because the only thing you can do to me, other than give me the $4, is force me to buy Best Buy for a net of $8.50. I don't have a problem with that. I think that's a great deal. So for me, this is free money. You're just handing me money for something I would do anyway. Would you buy Best Buy for $8.50? Yes, I would. Well, then here's some free money. All I'm doing is sticking to that statement. and I'm getting paid to do it. That's what short put selling is. You decide what you're willing to pay for a stock. You pick it out. So I look at IBM, stock of the year, don't forget. Also heading into a very virtuous cycle. And they're at 140. So I say, at what price would I sell other stuff to buy IBM? At what price would I be so excited about the price of IBM that I would sell something to buy it? Well, if you look at the chart, let's say we want to take a look at the chart first. And I already know it's that 115 is where I would buy IBM. Let's see what the chart says. IBM. So if I look at the chart and I'm wishing I could buy IBM, I see that 103 was a low, but it didn't last very long. So effectively, 110 was the low, and people came in and bought quite a bit at that level. Anywhere around 115, I'm kind of interested. I know that. Generally, IBM's been in the 130s, and the 200-day moving average is at 130. So 130 is a good cutoff line. So if I'm going to commit, if I'm going to commit to owning IBM long term, I know 115 to me is a free ride. I think 130 is not bad. So the question is, am I getting paid enough to risk at 130 versus 115? And that then depends on how much I want to have IBM in my portfolio. I already have IBM. I don't need more stock, but if I want to raise money, I can get $7 a share for promising to buy more IBM at 115. That's worth it to me. My net is 108. My net is below the 2-year low. And IBM is currently at 140. It would have to drop about 20% before it goes in the money. So would I absolutely buy IBM if it dropped 20%? Yes, I would. Okay, then I would be very, very interested in it. So therefore, for me, that $7 is free money. I don't mind making that promise. Of course, I have to be able to afford to buy IBM. If I can't afford it, it doesn't matter how much I want to buy it, I can't afford it. And I'd have to liquidate. Then it's not the right stock for me. But as I'm saying though, IBM here, you pick a stock. That was the point I was making though. You decide what stock you want to own and then get yourself paid for promising to own it. All right, Tesla. I don't like Tesla. But let me see if I make that go down faster. Oh, where's the thing? Oh, there it is. Okay. All right. I don't like Tesla, but I think they'll hold 150. And look what you can get for that. $25 for the 150 puts. That's a lot of money. That nets you in for 125. That's about half the current price. So that's my target for Tesla. Actually, my target for Tesla for next year. So you can get $8 for this year, and then it goes up to $25. It really shows us a lot of people who think they're going to go down. I don't like Tesla enough to do this, but I'm saying if you like Tesla, or if you have short bets on Tesla and you want to offset, that's a great offset. Because 150 is pretty low. 150 is a point at which I think you almost can make a case where you can be bullish on that. So it goes to any stock. You just have to decide how much you want to own the stock. And obviously we did Macy's and whatever. Limited Brands is another one I think is too cheap. $25. I'm willing to buy them for $25, and I can get paid $5. So obviously a 20% discount. I get $5 for promising to buy them for $25. All right, that's all it takes. You just figure out, you just think of a stock that you would like to own if it got cheaper and promise to buy it. Even one that gets away from you, like Micron has gone up 30% recently. They're now $42. And you say, oh man, I wish I'd listened to Phil and bought it when it was 30, right? Because it's too late now. But that doesn't mean you can't do it, because you can sell the $30 puts for $270. So all you're doing with Micron is going back in time to when we were loading up the truck down here at 32. So all you're doing is going back in time and saying, well, if it ever gets to that price again, I wish I would have bought it this whole time that I'm like banging the table on Micron and saying this is a great stock. And we had, in fact, it seems like a long time because it was last year too. We love Micron down here. Okay, I'm not very excited up here, but I was very excited down here to buy Micron. And that became a big position for us because it just kept being down there. And I was like, screw it, let's just keep doing it. But the point is, you missed it, fine, you missed it. It doesn't stop you from participating because you can still say, well, you know what, I can get paid $270 for the 30s, or I can get paid $370 for the 33s, and that's net 29 anyway. Right? So you can buy it for less money than we got in for, and you're still going to make your $3. So even when you miss out on something, you can still go back in time, promising to retroactively buy it if it goes back to that price. You're getting a lot less money than you got at the time. These puts were much more expensive, but that's how it works. Whoop. Uh-oh. Stop. That one. There you go. So what do we have in the options opportunity portfolio? See, in the OOP, we have the 40-50 bull calls, 40-55 bull call spread. We never adjusted that, and we sold the 33 puts. But see, we got 480 for the 33 puts, and now they're down to 360. So we're basically on track. Even with this, like, not the best performance, but we're still up considerably. But we've had that thing for ages. I think in the long-term portfolio, we're probably a lot more aggressive. See, we're not that, again, how aggressive you're going to be depends on how your portfolio is doing also. So we were, the long-term portfolio is making a lot more money than the OOP. So we can act more aggressively, and it's sort of a self-feeding loop, right? So in the OOP, we did you see here, we had these adjustments in 12/31. And we ended up with the January 27 calls. We partially covered them, and we sold those puts aggressively. So, we hit it right on the nose when it was down. That's what I mean when I was banging the table. Back in December when Micron went down, we loaded up the truck and got very aggressive with it, and now it's a huge winner. In fact, this, let's see, 13 times 40 is $120,000. Wait, no, $12,000 potential? How 13 times 40 times 100. 52,000, sorry. 52, so the potential for this trade is $52,000. Oh, that wasn't Micron, that's MJ. Oh my God, I'm losing my mind. All right. Sorry. So Micron is here. I was looking at the MJ trade. That one's working out nicely too, though. So Micron here, we've got the 35 calls, and that's from back in October. And we have the 55 short calls. We have the short puts, and we have some short 55 calls for 2020 that we should have bought back already. So that's that spread here. Now that one's up, whatever, and that is a $80,000 spread that's currently only, let's see, 52.7 minus 19.5 minus 6.750 minus 1.520, 24. So it's what do we say it was it's an $80,000 spread. So it's only $25,000. It has $55,000 potential left to gain if Micron gets back to 55. So then the question is, how realistic is it that Micron gets back to 55? I think it will over the course of 2 years, over 18 months. There's a huge amount of upside potential left in that trade. All right, so already making, it's hard though with these trades. It's very tricky because you're already up $10, $13, $14,000, and that's a lot. It's in fact our net when we entered was only 22 minus 12 hours. We only spent 10,000 to enter it, and we're up like 14,000. So we're up 140% already, but there's still $55,000 left on the table. You know, these trades make so much money when they go right. And that's the thing about a lot of these trades that we do. We do these trades, we use very little cash, what makes unbelievable returns when it's right. We're not always right, but the number that we're right and versus the times that we lose tend to really outweigh it. And that's how come we have so much, you know, that's why we get so much money in these portfolios. It can expand rapidly. And as we do better, as in the long-term portfolio, we have more cash to spend. We're willing to take slightly bigger risks. And yeah, we have losers. You know, we lose money. Here's Helios Matheson's down. Other things are down. But on the whole, these winners are incredible. Look at our put. Here's the short puts, by the way. Every month, we try to find a put in long-term portfolio that we get $5,000 on. We have 21. Generally, we should have 24. The most we should ever have is 36, but we generally try to have about 20, 24 outstanding at any given time. And that way they mature at different dates and they roll over. So try to do it so there's like a quarter go every 6 months and expire. But meanwhile, these guys are up. 6, 8, I'm just being quick. 6, 8, 24, 28 minus 4, so back to 25, 27, 28, 29, 32, 33, 34, 38, 40, 42, 45, another 5 is 50, another 6, 7, so about, you know, about $55,000, $60,000 worth of profits on these puts. And that's exactly where they should be. But look how much they have left to gain. All the negatives here, if these guys all expire worthless, so there's $50-something thousand profit here, but here's 21, 30, basically 40, 50, 60, 70, 80, 95. So another 95,000, close to $100,000 more to gain. And all that is me promising to buy those stocks for a low price. All I'm doing is saying, Apple, I sold the 195 puts for $26. So my net is 170 or 169. But my net is like 169. Am I willing to buy Apple for 169? Of course I am. So it's free money. ALY 25, I sold those for 270, 22.50 is what I agreed to pay. They're 31 bucks now. Do I want to own it for 22.50? Of course I do. Broadcom, 180 puts sold for 20 bucks basically, 160 net. They're 275. Would I buy it for 160? Of course I would. Boeing, when Boeing went down, and again, we're opportunistic, right? When Boeing had their problem, we put our foot down here. We sold the 280 puts for 21 bucks, so we're in for 260, 259. They're at 350, so $100 below the current price. And again, and this one's mostly still, you know, mostly still we have $16,000 left to gain. Best Buy, sorry, Bed Bath & Beyond, I always do that. Bed Bath & Beyond, 15 bucks, we sold the puts for 4. Our net is 11. They're at 11 now. This is one we're losing money on technically, but you know what? We're not really losing money because our net is 11. And if they stay at 11, we're gonna break even. That's how, you know, so right now we show a loss, but it's nowhere near as bad as it looks. See, same thing. So H1 Caterpillar, we always like Caterpillar when it goes down. We agreed to, I mean, it's silly. We agreed to buy it for net 90. And it's 133 now, so that's not even something. And that's the thing, when they get to like 133, when your net is 90, you don't have to worry about them anymore. They're not really an issue for your allocation. And if you have a portfolio margin account, if a 20% drop is still out of the money, you basically have no margin requirement on it because portfolio margin accounts generally unless something's very volatile, a portfolio margin account is going to assume a 20% drop in the security you have. So if I have a put that's more than 20% in the money, or out of the money, 20% below where the money is, then I'm going to have virtually zero margin requirement on that put. All right. The only problem though is obviously if the market drops in total, all of a sudden all those margins kick in, and you suddenly have a margin issue. So you always have to be careful about where you are with those things. In fact, in the fall, we bought back a lot of these puts. We bought back a lot of the short puts in the fall exactly because of that. We were worried that a big drop in the market, which we did have in December, would hurt us margin-wise. So we cleaned up our puts. We probably bought half of them back, and then we reissued a lot of them. That's why a lot of these things have later dates in 2019. The at least 19, 19, 19, 19, 19, 19, 19, 19, 19. All those, so this whole half over here is basically ones that since the drop we did, and even this one is late 2018. So all these puts that we added, which is interesting because basically it's alphabetical, so it doesn't make any sense. But in this part of the alphabet we added basically after the market crashed, and this is our new batches, and these are the only old ones that survived. But like I said, we're already up 50,000. We have another 100,000 to go. That's $150,000 worth of puts we sold in a portfolio we started 18 months ago that was originally $500,000. So if you make $150,000 on $500,000 in 2 years, that's 30%. So 30% of the value of our portfolio, of our original portfolio value, we made just selling, or we plan to make just selling puts. It is such a powerful tool. I cannot possibly emphasize enough how it's like the cornerstone of what we do in trading. We sell puts, and these aren't even all the puts. These are just the naked puts we sold where we don't have positions. Then, of course, a lot of short puts that we had ultimately converted into positions, and we add to those. So when we feel secure about the short put, we say, okay, well, like Caterpillar, for example, it's too high now, we're not going to do it. But Caterpillar, once it's stabilized over 100, we would say, okay, well, now we like Caterpillar still, so now we can buy the full spread to pick a bullish spread. We already paid for it with the short puts that we sold. We didn't know for a fact they would do well, but once they start doing well, we say, well, that's kind of free money. We can put that towards the spread and now enhance those gains. And that's all we do. We do the same thing over and over and over again. It's just that we do it over the course of months and quarters, and you don't really see it unless you look backwards and think about how we built these portfolios. But that's why it's really good in PhilStockWorld to go to the portfolio tab where we keep them. And it's good to go back in time and look at the positions, and you go to older articles and you look at some of the old reviews we have, like here's the June 2018 review. And in June, we were up $200,000 on the two portfolios. So we were nowhere near, here, 643. We were only, remember we started at 500,000. And we thought this was a lot of money. I said, this is embarrassing how much money we're making. We thought that was a lot of money, but we started with 500,000. We made 143,000 at the time. And it's the same stuff though. Look what we have here. A whole bunch of short puts, totally, by the way, totally different short puts than we have now. There's hardly any of these are the same. Because at any given time, we're picking all the things that we think are real bargains and selling the puts on those. And then when they resolve themselves over the course of time, and this was a year ago, when they resolve themselves, we take them off the table and find something else that's a better bargain and sell those. But that's all it is. It's not a complicated strategy that we do. And then it's interesting to look at these positions and see which ones changed and what we did and what our comments were at the time. But here's Apple, Barrick, ALB, which is being terrible for us, frankly. Alaska Airs, so that's still a favorite. Amgen, I think we're out of it at this point. Here's Bed Bath & Beyond. Been playing that forever. Citibank, we've been playing forever. CDE, I think we're done with. Chesapeake, I think we're still in. China Mobile, I used to love it. I don't know if we still have those. Here's Chipotle, which has been a hell of a saga. You know, and you can go back though and look at the comments and look at what we did, because that's, you know, it's an important insight as to when we're trading things down, we do new trades. It's like, this is where this logic comes from. But, you know, I don't want people thinking it's more complicated than it is, because it's not. We look for a stock that we think is really cheap. If we think it's really, really cheap and has a good story, we might go and right away pick a position. But generally, the first thing we're going to do is sell some puts, like we did on yesterday, we sell some puts, then we see how it goes, and if we like the way it goes, we add a spread. And in fact, let's see what's blue on here. Let's see on this portfolio review. These are the blues. Disney. Let's sell some July calls. It was getting toppy. Disney, don't want to look a gift horse in the mouth. Let's sell July calls, because it went up and we decided to sell. FNSR. Again, we had apparently the market was doing well here, so we were selling calls and picking that. HMNY, that didn't work out at all. We kept buying those and it never helped us. HRB we stuck with, and they finally paid off for us in the long run. LB still languishing basically. NLY, OPK, TAC. Much as I love them, we can cash these out. You know, and again, we were at 7 out of 8. We could only make 8, and we had already made 7, and we had a long time to go, so we got out of it. That's what you got to do. You got to look at every position and look and say, is this thing worth keeping anymore? Am I only going to make $1 over the next year? And if I have $7 and I'm only going to make $1, I know I can do better than that. We do better than that all the time. That's only a 15% return. That sucks over the course of a year. We can do better, therefore we change it. And that's what this is all about. It's not a complicated strategy. We work our way into positions over time, and we get, if they go down on us and we still like them, we get a little bit more aggressive. All right, so let's see. Burns asking if I think Best Buy, Bed Bath & Beyond. Do I think Bed Bath & Beyond will cut the dividend? I don't think so. I don't think they have a cash problem. I honestly don't. If they do, I would consider it, I don't mind if they do, but I don't think they've got a cash flow issue. I think they spent money, they restructured, only to the extent that the restructuring isn't working already, but I don't think they would make that decision this quickly. I just don't see that being a signal they're going to want to send today, so I doubt it. That's my answer. If they do, I don't mind, because I think the dividend's a bit high right now. It's where are we? They're 6%, so I mean, if you say cut, would they cut it down to 50 cents? Would they cut it down? It doesn't seem worth it. If I'm the CEO of Bed Bath & Beyond, it seems kind of petty to cut my dividend here, just because 6% is a little bit high, and generally we pay like a 3.5%, 4% dividend. If they cut it to 4%, that would take it from 68 to 50. And how much would it save the company? Again, we go back to the financials, we look at the cash flow, and what are they paying out? Oh wait, is this annual or quarterly? This is annual, and their dividends are only $86 million, and their cash flow is $160 million. So for them to save, let's say they save $25 million in dividends, why? They don't have really a cash flow issue. If you look at them quarterly, they have they did their restructuring here, so that hurt. But generally, their cash flow is in pretty good shape. And unless they see this being an ongoing problem, which would really concern me, I don't see where it's worth it just to scramble for $25 million. It's not really where I would go first as the CEO. All right, so that's about it. And we'll see what the market's doing, and things come down a little bit more again. Look at that. Wow, wacky. So up and down and up and down, and now we're sitting over here. And the S&P though is still, you know, very close to 3, looking like it's trying. The Nasdaq's over 79, and the Russell's up at 1570. Oil still holding 60s. Gasoline hit 201, but is back down now. So all is well, I guess. The dollar, though, I don't think it's going to stay down. So now we're going to probably get a pop that's going to knock things lower. So I still like those shorts we talked about this morning. But you just got to watch your lines and make sure we're not popping over. And at the moment, obviously, the Nasdaq is the one that still hasn't come down very much. But I would use the S&P because 3,000 is such an easy stop line to set that it's more fun to use for a short. And what I'm expecting is the dollar. There's nothing in Powell's thing. When you hit the international communities and everybody opens back up their markets, Tokyo and London and all that, open for trading, I think the dollar will come back up and strengthen. That'll drive the indexes a bit lower, at least pre-market. So, you know, if you're up all night and you want to trade, that's the way I would look at it. But that's about it for this one. So let's wrap this thing up, and we will do it again next week. All right. Thanks a lot, guys.